Welcome to The Explainer. Today, we're looking at a piece of the personal finance puzzle that literally affects all of us, and that is figuring out how to optimize the cash that's just sitting idle. We're going to completely break down how to take your unspent money and actively make it work for you. Let's get into it.
You know that feeling when payday hits, right? You've paid your rent, bought your groceries, covered the bills, but where does the leftover unspent money actually go? Well, for a lot of us, it just sits right there in the exact same account we used to buy our morning coffee. It's basically just gathering digital dust. And leaving your unspent money in the wrong place isn't just inefficient, it's honestly a massive missed opportunity to let that money multiply all on its own. So how do we actually solve this idle money problem?
Section 1. What exactly is a savings account?
Okay, let's dive into this because the distinction is beautifully simple. A checking account is for spending, a savings account is for not spending. It's really that straightforward. If you mix the money you intend to spend with the money you intend to keep, well, human nature pretty much guarantees you're going to end up spending the whole shebang. So the very first step to leveling up your finances is deliberately separating your spend now money from your spend later money.
Basically, a savings account is a deposit account at a bank or credit union that's specifically designed to hold funds you just don't need for immediate, everyday spending. It's a super secure, safe place to stash cash for those medium to long-term goals. You know, building up an emergency fund, saving for a car down payment, or finally planning that vacation. And the best part? While your money is just sitting there safely, the bank actively rewards you. They literally pay you interest just for keeping your money with them.
Section 2. The magic of APY.
So APY stands for Annual Percentage Yield. This is the real annual rate of return on your deposit account, and it factors in how often your interest is compounded. Let's kind of pull back the curtain here on why the bank pays you this yield in the first place. When you deposit money into a savings account, the bank doesn't just, lock it away in some dusty vault. They actually use your money to make loans to other customers. And in exchange for letting them use your capital, they pay you a percentage of your balance over the course of a year. That percentage is your APY.
4%. Right now, this represents a totally realistic, really solid APY that you might find out there in today's banking landscape. So let's look at what a 4% yield actually does for your wallet in practical terms.
Let's say you deposit a flat $2,000 into your account. The bank applies that 4% APY over a year, and boom, you earn $80 in interest just by letting that money hang out there. Your final balance is now $2,080. But what's really interesting about this is that because interest is typically compounded monthly, meaning you are earning interest on top of your interest month after month, you actually earn slightly more than exactly $80. Your money is literally making its own money.
Section 3. Traditional versus online banks. Let's talk about the cheat code here.
Based on our source material, APYs vary wildly depending on where you bank. Traditional brick-and-mortar banks, they often offer rates hovering around a tiny 0.5%. Meanwhile, online high-yield savings accounts are offering rates up in the neighborhood of 5.0% or even higher. I mean, that is literally a 10 times difference in the yield you're getting paid, entirely based on where you choose to park your cash.
So you might be wondering, why on earth are online banks willing to pay you so much more? Well, online-only banks typically offer much higher APYs than traditional banks simply because they have lower overhead costs. It's just pure business logic. They aren't paying for thousands of physical branches, crazy property taxes, or staffing for local tellers. Because their costs are so incredibly low, they pass those savings directly onto you with much higher interest rates. If you are totally comfortable managing your money through an app, you can unlock some serious rewards.
Section 4. The catch. Withdrawal limits.
So the crucial point is that savings accounts do have strict boundaries. Now, historically, there was a federal law limiting you to 6 withdrawals per month. And while that specific federal rule was actually suspended back in 2020, individual banks very often still impose their own limits. If you exceed those limits, you could get hit with penalty fees, or the bank might even forcefully convert your account into a standard checking account, stripping away that high APY entirely. Long story short, these accounts are just not built to handle your high-frequency, everyday transactions.
It's friction by design. Actually, think of it more like a built-in safety net. That withdrawal limit, the potential fees, it's totally intentional friction, meant to be a psychological barrier that keeps you focused on your goals. It forces you to pause and ask yourself, do I really need to pull money out of my emergency fund for this? If you're someone making dozens of daily transactions, that cash absolutely needs to stay in your checking account.
The savings account relies on this friction to make sure your unspent money actually stays unspent.
Section 5. Savings versus checking accounts. Let's bring it all together.
This really illustrates how these two work together. Your savings account is for storing your money, earning that sweet APY, and protecting your goals with limited withdrawals. Conversely, your checking account is your pure spending tool, effortless daily transactions, no withdrawal limits at all. These two act as halves of a complete financial ecosystem. Think of your checking account as your financial dashboard for today, and your savings account as your financial ladder for tomorrow. You really need both to make the whole thing work.
Look, if your cash is just sitting in a traditional checking account right now, you are missing out on the magic of APY. It's time to take charge of your idle money, respect that friction by design, and start leveling up your financial setup. At the end of the day, based on everything we've covered in this explainer, you really have to ask yourself, is your unspent money working for you while you sleep?